For those of you who are new to funds, we've got our Head of Research, Tim Murphy, here today to talk about some of the basics. Tim, thanks for coming in.
Thanks, Nicole.
Tim, let's start with the absolute basics. Why should we invest in funds?
I think that the key benefit to investing in a managed fund is the quick diversification that it gives an investor. By simply investing in one fund, let's say it's a large cap Australian equities fund, you're typically getting access to 30, 40, 50 or more stocks in one simple transaction, whereas the typical investor wouldn't necessarily have the ability to have that level of diversification if they go out there and start buying their own collection of stocks, because most people don't have the breadth of portfolio to be able to go out and do that themselves.
So funds are suitable for those who are just starting out?
Absolutely. I mean, there's no better place to start for a relative rookie investor than starting in a managed fund because of the diversification that brings. It's a much safer investment and much better way to learn about the market than by simply buying 2 or 3 shares that you may have heard about from your dad or your friend or read about in the newspaper or whatever, because you've obviously got a lot of stock-specific risk there. And if 2 years ago you'd gone out and bought 3 shares and even just one of them might have been Orco or Babcock and Brown or Centro Properties Group, then straight away there's 33% of your portfolio you're never going to see again. Whereas you buy in a managed fund might buy a stock like that does go down, but it's typically going to be a small part of the portfolio. So if that does happen, it's not going to be a terminal event for your investment portfolio.
How many funds are there to choose from?
In Australia, there's upwards of 11,000 different managed funds currently across both direct investment unit trusts and superannuation funds or allocated pensions. So there's a broad, huge number, arguably too many, available in Australia across all sorts of different investment types like Australian equities or international equities or fixed interest, or an increasing number of more specialist funds investing in hedge funds or different commodities or various alternative strategies like that. So there really is a big, wide range of choices of different investments out there.
If we're getting started, how does someone know what kind of fund they want?
At Morningstar, we like to think most investors should keep things fairly simple. So if you're starting out, first place to start, I think, would be a large cap Australian equity fund. It's typically going to invest in companies like Commonwealth Bank, BHP, Telstra, Woolworths, large familiar names that you're going to know about, understand a bit about the businesses that they're operating, so that as you're starting out, you've got a bit of an understanding of what it is you're investing and what those investments are actually doing, and then how that's then translating over time to share price performance. So Australian equities would be a good place to start out, particularly for younger investors who've got a longer time frame. So depending on your risk profile is also going to dictate the type of fund that you're going to choose. If you've got a more conservative risk profile or a relatively short time horizon, say you're a young couple saving to buy a house in a couple of years, you're probably better off going with something a bit more conservative, maybe a fixed interest fund that invests in government bonds or corporate bonds, or a conservative, what we call multi-sector type fund that invests in a bucket of different asset classes. So it might be predominantly in fixed interest, but it might have a little bit in property and a little bit in equity, so that you do have a little bit of exposure to growth assets, but you do have that capital preservation, income generating part that making up a significant part of the portfolio there as well. So a range of different considerations you need to factor in when choosing a fund. And
do we need a planner to get into a fund?
You don't need a planner to get into a fund. Typically in Australia, most people do go through a planner, but there's, for the DIY investor out there, there's no need to do that. There's a number of different brokerage places out there where you can get direct access to funds where they waive the contribution fees. And places like morningstar.com.au give plenty of information about the funds that are out there and give you a bit of a feel for what might be a good fund, what might be not so good fund. So you can do a little bit of research yourself, find out, work out what your own risk profile is, and go from there. And the other key element of that too is, when thinking about investing in different funds, is obviously everyone has a superannuation fund who's working. So looking through your own superannuation material and actually exercising choice about what you're investing in there, I think is an important part too. Most people in Australia just tend to be in the default option in their superannuation fund, but that can be a really good place to start out learning about investing by just looking at through the different options that are on there on your superannuation menu, getting a feel for the risk profiles that should usually outline what are the less risky types of funds, what are the more risky types of funds, and from there you can get a bit of a feel for what sort of fund you should be looking at based on your sort of time horizon and your risk tolerance.
Well, that's interesting. If your super is invested in one sort of fund, does that mean the investor should look at some other kind?
Yeah, that's a very good point, Nicole. Yeah, absolutely, because you're potentially already doubling up on exposure that you've already got, certainly. So if you look at the typical superannuation fund out there, which is a default option, would typically be a growth fund that's got about 70% in growth assets. Usually half or sometimes more than that would be invested in Australian equities. So certainly, yeah, if you've got a discretionary investment portfolio outside of that, having some Australian equities can make sense because you have a bit more control over where you direct that. But you do need to be conscious of the Australian equities exposure that you do already have within that superannuation fund.
Now, how much money do we need to get started?
Ranges across different funds, but for some of the biggest fund managers out there, the minimum investments can start as low as $5,000 in some cases. Fees are a very important point to consider too. So a lot of the big retail funds out there can have high fees that are up 2% and upwards. And if there's one thing that's certain about investing markets when you're picking funds is that you can guarantee what fees you'll be paying next year. You don't know what return. The market may go up, the market may go down. So the one thing you can control is fees. So you should always, where possible, look for lower cost funds over higher cost funds.
Thanks, Tim, for that.
Thanks, Nicole.